As businesses evolve, companies may want to change the share structure either by adding a new shareholder or by changing the existing proportion of shares between shareholders. And here shares transfer would be one of the common ways that businesses follow to facilitate changes in ownership, investment, and the business strategic direction. Well, also some of the common reasons a shareholder would transfer their shares is because they need cash, or they would rather someone else to own them, or when one of the shareholders wants to leave the business. And here one of the most important questions, and before taking any action on changing the structure within the company, what will be the tax implications associated with this transaction? And that's what we are going to discuss within this video. Hello everyone and welcome to the Tax Gate. Hit the subscribe button and let's get started. Well, tax implications of transfer of shares would have an impact on both the seller or the transferor and the buyer or transferee as well. Taxes would be applicable and can be determined based on the circumstances of each and every transaction, the parties involved, and depending on the rules and regulations of each jurisdiction. Also, certain exemptions or tax relief would be in place, and once again it depends on the rules and regulations of each jurisdiction. Well, so now let's highlight the most common types of taxes that would apply on transferring shares. Let's start with capital gain tax. Capital gain tax would apply when we have any realized gains against the share transfer. So, in a different way, capital gain tax here should apply on the difference between the acquisition value of the share and the selling price or the fair market value upon transferring that share. And here one of the most important points to be highlighted that the transfer of shares should take place at market value, as it would be highly challenged to consider the value of share same as the acquisition value upon the time of transferring those shares. Well, also it is important to differentiate between the capital gains derived by residents, as here local tax rules should apply, and the capital gains derived by non-residents, and here normally double tax avoidance treaty rules would apply, as the beneficiary would enjoy any tax relief under the tax treaty. Good. Now let's move to the stamp duty implications. Stamp duty is almost always applied on the buyer or the shares transferee. However, in some jurisdictions it would apply on both shares transferee and transferor as well, either resident or non-resident. So, it is very important to assess the stamp duty implications of a share transfer and ensure being compliant with tax regulations of relevant tax jurisdiction. Good. And finally, once again, the tax rules and regulations of each jurisdiction should be carefully reviewed in order to properly confirm the applicable taxes along with the exemptions or tax reliefs that would be in place. Like and subscribe as we have more interesting tax videos, and thanks for watching TaxGate.